Welcome to the Wealth Under Pressure podcast. Financial success very often has less to do with owning a financial product, earning a high income, or even being frugal. Instead, the path to success comes from having a comprehensive plan that enables you to optimize decisions and avoid mistakes. Join John Smallwood, a certified financial planner, as he identifies key areas of pressure on people's wealth and strategizes to reduce it. It's time to liberate your wealth.
Hello and welcome to episode number 9 with John Smallwood. Today we're going to talk about the 9 things you need to know about the 2018 tax law. All right, John, well, we talked about this a little bit on the last podcast, but there's so much more stuff that keeps coming out. Let's talk. What do you got for us?
So sitting back and looking at this law, some of our financial planning software was updated with the tax law changes, and it's very, very interesting. And there's this list of 12, there's a concept called QBI, right? And our whole presentation last week was on the QBI and what is QBI, and I hope you have it. I hope it's, I hope it's contagious and you get more of it. Right?
Say what QBI is one more time.
Yeah, we're going to get there. Okay. Qualified business income.
Gotcha.
Okay. So the thing that I'm hearing is people are really upset about SALT, okay, which is the state and local income taxes. It's only going to be capped at $10,000. Some states that really doesn't matter, but in the states that we live in and the way, where I work and everything, it really matters because we have high taxes and we have a high income tax. And people are upset about it. And I don't think they need to be. The personal exemption going from $12,700 to $24,000, interesting. The mortgage interest deduction on the first $750,000 of first or second homes is deductible. If you have a mortgage that was prior to the end of this year that's over the $750,000 but below the $1 million, you can continue to deduct that. But if you refinance going after December 31st, 2017, you're limited to the $750,000. What I'm seeing that nobody's really been talking about is home equity line deductions are gone.
Okay.
Which is huge. Like, how many people deduct their home equity line of interest?
Absolutely.
Everybody does. Right. And I think what's really interesting is I haven't found the piece yet that says, is that new home equity lines or is that all home equity lines? And it doesn't seem to be a clear distinction on that, so we're trying to figure that out. Again, the corporate tax rate, dropped to a flat 21%, and the top bracket at 37%. So as we move into this, we get these deductions, and I have to look at this from $470,000 of income under the old adjusted gross income in the tax law, puts you in the 39.6% tax bracket. Now, from 400 to 600, you're in a 35% bracket, and over 600, you're in a 37% bracket. So the bracket reduction is pretty significant, all right?
Mm-hmm.
But the qualified business income, this is one of the biggest misconceptions that I'm seeing out there, is that qualified business is any trade or business other than the following. And the law, and it's any company that business is as employees, which I think factors in lease employees, but healthcare, law, accounting, actuarial, consulting businesses, performing arts, investment management, consulting, partnership interests, athletics, financial services, brokerage services, and my favorite one out of this list is any trade or business where the principal asset of such trade or business is the reputation or skill of one or more of its key employees.
How did they come up with that?
What business doesn't have a star?
I know. I don't. What is that? That seems, it seems a little bit specific, but at the same time, what?
Yeah. So how do you I can't wait to see how they're going to enforce it and how they're going to rope you into that. But I can think of many companies that don't fit these categories but the relationship, you have a star salesperson who's driving the majority of all the sales into the business, and that's what's creating the revenue. If that person left and went to another company, well, the sales would leave to that person. So therefore, it is the skill of one of these key employees. All right. So QBI is this qualified business income. What's not factored in the income is any short or long-term capital gains or losses. Dividend income is not factored. Interest income, reasonable compensation paid by the business, or guaranteed payments to a partnership. So basically, if you're an S corporation and you gross $400,000 and you pay yourself $100,000, your qualified business income is only the $300,000. If you're a partnership and you do the same thing, that guaranteed, but you give yourself a guaranteed payment, that guaranteed payment is not part of the QBI, part of the qualified business income. And so when we start looking at what's going on, so you got that dirty dozen or the dirty 13 or whatever you want to call it, the 13 businesses that are excluded from it, which when you look at most businesses, they kind of fall into that category. A consulting business. Well, what is consulting? I'm an educational consultant. Well, what is it? I'm going to fall into the category, okay? But if you start thinking about it, it phases in. If your income is below $315,000, married filing joint, your adjusted gross income plus the $100,000, you're automatically getting this 20% business income deduction, and we'll explain how that works in a second. But what's really interesting is, so you're a healthcare professional making $300,000 a year, you're going to get to deduct 20% of that qualified business income away from your income. So make it really simple. Qualified business income, $300,000. Let's say it's all Schedule C. You take 20% of the $300,000, that's $60,000. You're only paying tax on $240,000. Was that math right? Yes.
Yeah, I'm spitballing the math right here. So yeah, it sounds like you're right. Yeah.
Yeah. No. So now, if you go back to what I was talking about before, without deductions and all these other things, you were paying tax on $300,000. You were most likely in the old bracket in a 33% effective bracket. Anything between 233 and 416 was in a 33% bracket. Now the new tax law, you're only paying tax on 240. That's actually putting you in a 24% tax bracket. That's a tremendous drop.
Yeah.
Right?
Yeah.
And everybody's running from this. So that qualified business income, if you're below, if you're one of those excluded carriers and your income is below 400, which for a huge portion of the self-employed population, you're under that threshold. Right? I mean, that's where the bulk of it is. So you're going to get this benefit when you cross over the 315 and you're going to the 415. If you're one of those excluded businesses, it's going to begin to phase out over time. We'll talk about the phase out later, but it phases out when you hit the 415. If you're one of those excluded practices, you're not getting the benefit of the qualified business income deduction, but you're still getting the benefit of the lower tax brackets.
Okay.
So to bring the deduction into light, if you're above that phase-in amount of the 315 plus 100,000, the deduction becomes the lesser of the three options. Okay. So in the example, 20% deduction of the qualified business income. What's that number? 50% of the W-2 wages paid by the business with respect to the qualified trade or business. That's one part of the deductible. And then the sum of 25% of the W-2 wages plus 2.5% of the adjusted basis of the assets of the corporation. So what I think they were trying to do there is, if you have a capital intensive business where you benefit from accelerated depreciation and you have $1 million worth of income, but you have $500,000 worth of depreciation, so you're only paying tax on $500, you're gonna have to it's going to be the lesser of the W-2 wages, 25% of the W-2 wages plus 2.5% of that basis of that product, which is going to bring you down to a lower number. So if you have $1 million of qualified business income, you're either going to get a $200,000 deduction, so pay tax on 800. If you pay W-2 wages of 100,000 in that same business, you're only going to get $50,000. And if you had W-2 wages plus, the 2.5% rule, you're down to 25,000 plus whatever the 2.5% of the assets of the corporation. So it's the lesser of those three.
Okay.
You're still going to get a great benefit. It just has to do with who you are, how you're structured in the business that you're in. Mm-hmm. And if you're not one of the 13 that are excluded, but you're in the ones that are included, your deduction is going to be interesting. So how you pay yourself, reasonable compensation comes really to be, I think, a very important conversation, and how you're running the business structure itself. Am I losing you, or are we here still?
No, what I'm trying to do is I'm trying to keep myself organized here, because we talked about the 9 things, and I'm trying to run through how many of the 9 things you've already gone through.
All right, so we define what the qualified business income is.
QBI number 1, good.
We determine who's excluded.
Who's excluded.
We've determined who's exempt from that exclusion. So if you're below that 315 and the 415.
Got it.
All right. Now we're talking about what are the deductions, meaning the 20% or the 50% of the W-2 income, right, or the third one.
Okay, got it.
That's number 4.
That's 4.
Now we're gonna jump into what types of entities are going to benefit from this pass-through entity.
Okay,
so
gotcha.
That's going to bring us to number 5.
Okay, beautiful. Let's go.
All right. So now here we are at number 5. So I'm a Schedule C, or better known as a sole proprietor. That's one entity. So the checks are payable to you. You're filing a Schedule C on your tax return, which flows through to, I think it's line 12, business income, Schedule C or C easy on your tax return, and you're a sole proprietor. A limited liability corporation, a partnership, or an S corporation. Those are basically the 4 types of entities that are going to qualify from this. If you're a C corporation, you're getting the benefit of the 21% tax, but that's not a pass-through entity. That pays tax by itself. So the distinction is, I'm a sole proprietor, I'm a limited liability corporation, I'm a partnership, or I'm an S corporation.
Mm-hmm.
So those entities qualify for qualified business income.
Okay.
Which is 90%, 95% of the organizations that we're going to see.
Mm-hmm.
So the big question is, and everybody's asking me, do I have the right entity? And that's really, there's no magic bullet. It really comes down to who you are, what type of business it is, what your assets are, what your deductions are, etc. So one of the things that we thought was pretty interesting is and I created like a summary of this that basically outlines a very simplistic person who has no assets except for the following. They're 48 years old, no kids, husband and wife. They have Schedule C income, sole proprietor, $400,000.
Okay.
They own a home worth $650,000. Their real estate taxes are $15,000 a year, and they have a $450,000 15-year mortgage at 3%, which is basically down to 12 years. All right, there's 12 years left on it, and no other assets, no accumulated retirement assets, no cash, no 529s, nothing. Just simply this, because what I wanted to do was to kind of create sort of a how bad was it, and where am I now? And then draw comparisons, okay? But not to get into the weeds, but basically that person would have, in the state of New Jersey, would have paid about $18,000 in New Jersey tax. They were paying $15,000 in real estate taxes, and they were paying $13,000 in mortgage interest, so they would have had $44,000 worth of deductions. And the Schedule C person with that kind of income would have also paid self-employment tax of about $26,000, which they get half of that for a deduction. And we have, this is the conversation, but what I'm focused on is that structure would pay about $138,000. It was $138,000 in taxes between self-employment tax, federal tax, state of New Jersey tax. And that's kind of, and as you pass through this new strategy and the new law, what's happening is that same individual is now getting the same income. Your itemized deductions are now limited. Instead of being $44,000, they're now down to $24,000 because all you're getting is $10,000 for the assault, and you're getting $13,000 for your mortgage interest. So that's only $23,000. So you're defaulting to the $24,000 deduction.
Okay.
Making sense, okay?
Yeah.
Now, what's interesting is the 2018 tax forms are not out yet. The government has not posted them, so you don't know where to take this QBI deduction. But in essence, this person with $400,000 of self-employment income would be benefiting by $72,000 of the qualified business income. So a $400,000 income earner gets to deduct half of its self-employment tax, which would be $13,000, which would bring the adjusted gross income down to $386,000. Take away the standard deduction for $24,000, brings the taxable income down to $362,000. But then you're getting about a $72,000 qualified business income deduction. So now you're paying tax on $290,000, which you were paying tax on $338,000. Translation is your taxes have dropped from $138,000 down to $123,000. Powerful, right?
That is super powerful. Okay. So what's number 6? I'm sorry.
So when you compare that to an S corporation, you're going to get different outcomes, okay? And the taxes, literally, as you go through it, you switch that income from $400,000 Schedule C to $100,000 salary from an S corporation and $300,000 of S corporation tax, and the tax drops another $16,000, almost $30,000 combined in this scenario that I am doing, which is probably, not accurate because people have other assets.
Right.
And they have kids and things like that. So again, you need to be very, very careful on this. You really need to consult your financial advisor, your accountant, and you need to look at it. But my excitement is it's January. If we don't do something now, we're going to miss the whole year. Right. And we have to put things in place now so we can get the whole year. And if it means doing an analysis of my entity to determine what entity should I have to benefit from this tax law, I need to do that now. And I need to walk through and see, how do I pay the least amount of tax for this? The SALT deduction is really interesting. Okay, so the impact of SALT is if you have a mortgage and you lose your state and local income taxes and your mortgage interest is basically below $14,000 because it's the $10,000 for the SALT and $14,000 would take you to $24,000, you're going to, itemize versus the standard deduction, you're not getting the value from your mortgage interest deduction. You're better off just taking the standard deduction. So now a mortgage is a tool, right? And that tool, it's a financial product that allows you to buy a house, allows you to pay for the house over time, to spread those payments out over a long period of time. But like any tool, am I holding the tool properly and hammering with the right methodology to get the maximum value out of that hammer? Am I a 10-pounder guy or a 2-pounder guy? I mean, I worked construction one summer and I picked up a hammer and, I was hitting my thumbs and breaking it and crushing it. And the guy next to me had been on the job for, I don't know, a long time. And he was 2 swings and his nail was in. And he's like, "You got a long way to go, Smallwood." All right. I think I only lasted a week. It was too hot. I needed a desk job.
Yeah, well.
But the theory of this is that you really need to understand how to do the SALT deduction. And I think what's really interesting is, as I started to play around with the mortgage interest, you need to understand if home equity lines are not deductible and I don't have over $13,000 worth of mortgage interest and I'm paying for this in the right way, the whole goal of every financial strategy, and you've heard me say this a lot of times now, over 9 times in 9 different presentations, is I want to reduce taxes. I want to reduce risk. I want to increase the benefits around my wealth. I want to accumulate more wealth so when I retire, I can have the most tax efficient retirement and pass the maximum on to my family. So we started playing with that $450,000 mortgage, and we said, oh, what if we refinanced it to a $450,000 30-year fixed rate mortgage? We went from a 3% rate to a 4% rate, which why would you ever do that, right? Why would you ever increase your rate? And we went to a 30-year versus a 12-year. It was interesting. You drop your payments by about $1,600 a month, but your interest deduction went up to $17,000 for a lot less payment. And when you did that, that created a whole bunch of other ripple effects at both the Schedule C and the LLC, acting like an S corporation, where you dramatically increase your tax savings, almost $8,000 or $9,000 just in that little move. And the interest deduction only changed by $4,000, but it had an impact on the AMT. And I say this to everybody: a financial plan is like throwing a rock into a pond. I do something, and then there's that ripples, right? And those ripples keep going and going and going, and they will touch all the shores. One small little pebble will ripple across the entire pond and touch every nook and cranny of that pond, and it'll have a different impact as it goes along. So mortgage interest, we want to make sure that we've maximized the mortgage interest deduction for the individual person. We're not saying you need to refinance your mortgage, but you really need to understand how do you benefit from it and how's it going to improve upon my plan. Because again, we have to have some kind of belief that this is either going to be here to 2025 and sunset, or it's going to be here for the long run. And I don't know which camp the listeners are in, but I want to plan based on 2025. And as we get close to 2025, rethink it again, right?
And that's really not as far away as people might think. I mean, okay, so number 6 was SALT. What's number 7?
Mortgage interest.
Okay. I'm just trying to keep you organized here, dude. That's all. So what's number 8?
So number 8, tax deferral.
Okay.
Should I defer or should I not defer?
Okay. Yeah.
The sole purpose of tax deferral, when I say tax deferral, it's deferred compensation, it's a 401k contribution, it's a profit sharing, money purchase defined benefit contribution. The sole purpose of tax deferral is to take money from a high tax bracket and defer it to a low bracket, right? Take it from a 40% bracket to a 30% bracket. If I do that, I win. But if I defer from a low bracket to a high bracket, let's just assume I didn't make any money on my money for a second, right? I put $10,000 in the 401k plan, deferral. If I didn't put it in, let's say I would have paid $3,000 or 30% in tax. Time period goes by, 7 years, and now I take it out and the tax bracket's 40%. Same $10,000 in there because I didn't make any money on my money. Just assume that for a second. Now I'm paying $4,000 in tax to get my money as opposed to $3,000. Did that make any sense? So what I'm finding is that depending upon the individual makeup of the plan, is under the old law, when I made a deduction, when I made a deferral into a qualified plan, and we ran a bunch of like solo 401ks for the self-employed people, the Schedule C people, and we said, okay, yeah, put away the $55,000 like you've been doing, or the $67,000 that you can get in some cases with a catch-up provision, et cetera, right? But put that in. In the old tax law, you were saving about, between the federal and the state in New Jersey, at that income level, you were saving about 43.5% on those deductions. And it's not really a savings because you're deferring it to the future, but you were deferring at 43%. With the new tax law, depending upon what your QBI is and all these things, the effective bracket at the end of it might only be 37, 38%. So now if I'm going to defer, and everybody, whether you're self-employed or not, the same question comes into play. If I'm going to defer from this low bracket that's temporary to a higher bracket that we might be going to, I really have to question it. And the decision is not just limited to should I defer or not defer, but how much money have I already accumulated in tax-deferred assets? If I have a lot of money, and that I may not want to do it. If I don't have a lot of money, maybe I do want to do it because my plan is not going to be as robust as my neighbor's plan. I see people that are not going to have that much taxable income in retirement because of the way their income is structured. So you don't want to have a big deferral coming out, but even the deferral might be in a lower tax bracket because you haven't accumulated enough wealth. Okay? So the tax deferral becomes really important. I think the 401 Roth, and most people, it's 5 or 6 years old now. Most people don't know about and haven't taken advantage of the 401 Roth. And the 401 Roth is like a 401k. So your employer sponsors a 401k, and you can defer under 50. Last year it was $18,000. This year it's going to be $18,500. And if you're over 50, you can put away more to catch up and get another $6,000 in there. Well, you have the choice to put the whole thing in as 401k, which is pre-tax, grow without taxation, but when you take it out, you're going to pay tax. Or I could put the whole thing in 401 Roth, let it grow without taxation, and get tax-free income in retirement. Or some variation thereof. I do 9 and 9, whatever the math is. And most people aren't taking advantage of the 401 Roth. They're only taking advantage of the 401k. So I'm thinking vehicles like the 401 Roth and tax-deferred life insurance cash values where you're paying the tax, it's growing without taxation, and you get tax advantage or tax-free income out of it in retirement becomes super important in funding and moving forward in this tax law. So tax deferral becomes unbelievably important.
Okay. Number 9.
My spouse makes a lot of money. Is that going to hurt? Is that going to hurt us with the qualified business income? Is that going to lose some of these deductions?
All right, hold on. I'm going to go back through actually, why don't you go back through 1 through 9 so that we can make sure everybody got everything.
All right, so we have number 1 was what is the qualified business income? Actually, 1 was the qualified business income. 2, who's excluded from the qualified business income? 3, where's that phase in or that exemption? 4 was what are the deductions, the 20%, the 50% of W-2 wages, etc. 5 is what entity, and do I have the right entity? 6, what is the true impact of losing my SALT, which for most of us, it doesn't matter, even in the high income earners, right? So I lost my state and local tax. So instead of getting $40,000 there, I'm only getting 10. But because I'm getting taxed at a lower bracket, it doesn't really matter. Good, okay. The mortgage interest deduction, which would be what number? I lost count already.
Mortgage interest, number 7. Number 7. And the impact of SALT was number 6. Number 6, yep. Number 7's mortgage, and number 8?
Number 8 is how is the tax deferral impacted, and whether to defer or not to defer, that is the question. And the last one is my spouse makes a lot of money in his or her job. How will that impact my qualified business income?
All right, well, let's go. What are we thinking about there?
So there's what I've been hearing is that from people is because my spouse is successful, I'm going to lose the benefit of this qualified business income. And you see a lot of households where you have a two income family house where spouse A works for the big corporation, they get the benefits, etc., and then spouse B is the consultant. And what we're finding is you're not going to lose the benefits of the qualified business income because if that income is under the phase out, you still should be categorized in the same area, meaning you're going to get the benefit of that 20% deduction if the business income is below the $400,000.
Okay.
So don't worry. Make sure your spouse continues to make a lot of money.
There you go. That sounds awesome.
All right. So my excitement on this is that as you dissect it and you start looking at optimizational strategies, which is make things more efficient, play with your mortgage interest deduction, play with your qualified plan deductions, play with all these things, done right, same cash flows, people can free up, in my $400,000 example, $30,000 a year that was going out the door to taxes. What's the potential of that wealth over your lifetime now?
It could be unbelievable.
It's unbelievable. If we could all put away, if you were already saving 20% of your gross income, and now you're going to put $30,000 on top of that, you're now your wealth potential is off the charts. If you weren't saving any money because you were stressed, you have to fool yourself and have to look at your future you, right? Right now, today, everything looks good. I'm 49 years old. I look good. The hairline's receding, etc. But I need to look at my 70-year-old me and make sure that 70-year-old me, like those lottery ads, right? That older guy was taken care of the right way. Use this opportunity to take this 30,000 or whatever it is for your personal situation and put it away for your future, so that 15 years from now, you've got a lot more money accumulated than you would have because you were prepared for the tax law. You were prepared for this. And when we get to this, 2025, if it sunsets and you lose it, well, you had 7 years of putting away additional money that's now going to grow. Maybe there's no more new money going away because you're back in the old tax law, but we can use this time frame to make things more strategically. But now you got that extra money compounding from, let's say 57 to 70. Wow. Or in a Roth going out even further. I think the ability to accumulate wealth with lower taxation has become so incredibly valuable through this tax law that the actual tax law has reduced the tax burden, and now strategy, along with the tax law and strategy, becomes the most important part of optimizing this tax law. And what I'm really focused on all of a sudden, I kind of woke up Friday after about 3-4 days of, really running numbers and thinking through things, and became very, very excited because if I get out on it early in the year and I do a really in-depth analysis now, maybe using my 2016 tax returns, right? Because, the CPAs are going to be very involved in getting the 2017 and kind of understanding, right? And that's because they got to tell us what to pay for last year from a financial advisory standpoint. Let us take the 2016, get an indication of what the 2017 looks, and then model how this 2018, tax law is going to work, and take action right now in January and February and March. So when I get to the end of the year, I've had the full benefit of those strategies at work in my plan. Because if I do it if I wait to December or I wait to April the following year, I just missed a whole year. So time is of the essence.
Gotcha. Now, this is not the last time we're going to talk about this, because as you had already said, the forms haven't even come out yet. Like, we don't even know exactly what's going to happen. And right now, as we're recording this podcast, our government's shut down. And so the how quick all of that's going to come out is we have absolutely no idea. So with all of that said, right, the 9 things you need to know as where we are right now in 2018 with this new tax law, any closing ideas?
The senators have struck a deal.
Oh, did they really? Okay.
Government, yes, it is over.
Oh, well.
Back to business. But the closing ideas are this. Get with your professionals right now. Build your plan, update your plan, get all the numbers right, simulate it through some sort of tax strategy. Look at all the strategies that you have. Take away your opinions, take away your biases, take away the hearsay, and look at, if I do this, what happens to my cash flow? What happens to my taxes? If I do that, what happens? If I do this, what does that, look at how we take the little deductions that we have left and how do we maximize them. And really, you really have to focus on whether or not deferral truly makes the economic sense that we think it does if I defer from a high bracket to a low bracket. If I defer from a low bracket to a high bracket, it doesn't make any sense regardless of what I earn. So the takeaway is sit with your professionals, sit with your CPA, really assess your entity, make those changes as soon as possible. Look at all your deductions that you're taking advantage of. Look at how your income is hitting your tax return. Look at your portfolio, make sure that the interest and the dividends and the capital gains are compounding and creating compound taxation, and develop strategy that's going to reduce your taxes going forward, regardless of what the tax law is. I mean, there are scenarios where people are saying, it's not 2025, it's going to be done in 2.5 years. it's going to be repealed. Well, it's 2.5 years.
Right. That's 2.5 years of paying taxes.
Right. And good strategy is good strategy. Right. And that's really the focus is for the, I'm a big fan of the golf analogy. If I spend all my time on a coordinated swing, meaning how efficient is my club head speed? Am I hitting it straight? And I spend all my time on the swing, the club is not that important. Meaning I'm going to hit the ball far with a bad club versus a good club. The good club's only going to hit me a little. It's only going to help me hit it a little bit further. But if I have a terrible swing, I could buy the best club known to mankind. I still can't hit it.
Right.
It's not the club's fault. It's the strategy. So strategy is the mother of all loads. That's what we got to focus on.
All right. And this was podcast
strategy.
This was podcast episode number 9. 9 things you need to know about the 2018 tax law with John Smallwood. For John, this is Matt Halloran. If you have not subscribed to the podcast, make sure that you click the subscribe now button below, because that way, every time John comes out with a new podcast, it'll show up right on your listening device. I hope all of you have a great day, and make sure you plan well.
Smallwood Wealth Management is a registered investment advisor. The opinions expressed by Smallwood Wealth Management and guests on this show are their own. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Information presented is for educational purposes only. Moreover, no listener should assume that any discussions or information presented serves as the receipt of or a substitute for personalized advice from Smallwood Wealth Management or from any other investment professional, and is not intended as an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Smallwood Wealth Management is not a law firm or accounting firm, and no portion of this presentation should be interpreted as legal, accounting, or tax advice. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation.